I'm pleased to welcome David Lundgren, CMT, CFA, back to the program to present the 4 Ps of investing.
The point here is that it's a 4-legged stool, and I believe there are 4 Ps to investing, one of which does not belong with the others, as the title here indicates. But I also, again, I have them sized according to the amount of emphasis people put on each, meaning that most people think that prediction is the most important thing. And I will have a lot to say about that, but truly it is a 3-legged stool. And you'll notice that psychology is barely legible because very few people appreciate the importance of psychology in investing. So we'll talk about that and more. We're going to talk about the 3 that do matter: the philosophy, the process, and the psychology. With respect to philosophy, that is that the index is just another strategy, and it's a bad one at that. Fundamentals, not opinions, matter more than trend. Sounds controversial for a technician, but nonetheless, you'll see what I mean in a moment. And then the market is the best fundamental analyst on the planet. So let's listen to the market. As respect to process, which is risk management, entry, exit, things like that, what we need is a structured, unbiased, non-emotional way of listening to the market. Also, we need a structured process to help us distinguish between good and bad volatility. Not all pullbacks are bad. Some pullbacks are good, and we need a process to help us identify which ones are good versus bad. And then lastly, this is my process. So the name of my company is Motor Capital Management and Research. And the motor stands for momentum and trend. And so what I do, I combine momentum and trend, because by putting the 2 together, you accentuate their positives while at the same time backstopping each of their negatives. And then the psychology, no predictions. This is a really difficult thing to come to realize as an investor. No predictions, but it's also it's an expensive thing to come to learn if you don't heed the advice of others. And so predictions is a really tough game. The point is that knowing what is happening is actually far more important than predicting what will happen. And so therefore, it makes no sense to spend any time predicting the future because it's virtually impossible. The most important thing is managing expectations. And although it's the most important, it's also the most overlooked, as I said earlier. On philosophy, let's say that I came to you with this really great strategy that I've located and identified and did a lot of statistical work on, and this is how it looks. It has multiple 30 to 50% declines. Several times it has actually spent more than a decade underwater. And by the way, it's got a maximum drawdown of 86%, and the annualized volatility is near 20%. So that's pretty high. You get all of this in exchange for a 10% return. If you went to any investor, any allocator, and described to them that strategy, they would say to you, "No, thank you. I'm going to move on to keep my investments in a passive strategy because I don't want anything to do with that." But what they don't realize is that is a passive strategy. That's the S&P back to the early 1900s. There's a lot of things that are wrong with just passive strategies, blindly accepting what the strategy delivers to you from day to day, week to week, month to month. Not the least of which is this volatility. I mean, this is just an unacceptable return stream to be underwater for 13 years, 12 years, 25 years, 30, 40, 50% declines, 86% maximum drawdown. So for this reason, I think it's worth looking to alternative solutions to just being fully passively invested. Trend following is about listening to the market, right? So identify those time frames, like this is a weekly chart, identify those time frames that are driven by fundamentals, like big, strong trends don't happen on the weekly chart unless there's a fundamental trend underpinning it. This is just a very simple way to identify opportunity and risk, right? So what we do know that as a stock can go up or down for any number of reasons fundamentally. Even the same stock from cycle to cycle can be completely different reasons for the stock to go up or down in any given cycle. And most people actually disagree with what the fundamentals are at the same time. So like why Tesla went up, everybody was in disagreement about it. People said it was the electrification. Some said it was the batteries and transport, and others said it was solar panels. And so, who knows what it was, but we know for sure that in this framework, it went up a lot. So we don't really know fundamentally from point to point or cycle to cycle what the drivers are. But my point is we don't need to know. But what we can say for sure is that these 4 boxes must be checked every single cycle. And so the 4 things that must happen, of course, are a trend line break, violate the last high or low of the prior trend, 50-day crossing, the 200-day, and then the 200-day turning up. So you can see that unfolding here. So there's your first box checked right there. Second box checked right there. Third is the crossing of the averages, and then fourth is the average itself turning down. So once you can check all these boxes, the market's telling you, as the best fundamental analyst on the planet, there's risk here. Fundamentals have changed, but the idea is to wait for the boxes to check in the other direction and heed the market's advice, and then conversely wait for it to break down again with no forecast as to when that will happen. So this is using price to identify risk and opportunity in the market. And so price is great in a really strong bull market. This is what most stocks look like. But the problem obviously is that with price trend, if everything's trending, you don't know which one you should own. So how do you know which of these uptrends should you own? And that's where momentum comes in. So momentum is a strategy that's been back tested all the way back to the early 1900s. These are the stocks with the best and worst momentum over time. And what it demonstrates is that the stocks with the best momentum over the past 12 months do the best going forward, and stocks with the worst 12-month momentum do the worst going forward. So the idea is, if you're trying to beat the market, fish where the fish are, right? If you're trying to win a fishing derby, go to the pond where all the fish are. In the case of momentum, that pond is these top 3 deciles of momentum. But putting these two together, you're constantly ranking the momentum of every stock in the benchmark in a really bad bear market, that even the best performing stocks could still be in a downtrend. So that's the problem with momentum. So momentum does a great job when you're in a bull market. It identifies those stocks you want to own. But in a bear market, it keeps telling you to stay long, even though everything's in a downtrend. So by putting these two things together, momentum and trend, you end up with an approach that looks more like this. So you're focusing on positive price trends here and positive relative performance here. And so in a bull market, this is leadership. And in a bear market, good place to source short ideas. This is a bit of a conundrum. What if you've got positive price but really bad momentum? Well, this was 2021. There were lots of stocks that were like that. And then this is the biggest conundrum of them all. We saw a lot of these last year where there were a lot of negative trends, but the market was so bad that the negative trends were still outperforming. Again, what you're trying to do with your process is you're trying to identify things that are in the top left-hand corner, because that's the market telling you this is the best fundamentals. I think this is the most underrated, but perhaps the most important part of what we're doing here as investors. It's all about expectations and mindset, and having trust in your process, and just having the belief that the process that you've put together is knowingly intended to guide you through all these different environments. So when you can identify which environment you're in, just trust your process. I put this question out on Twitter, and just to see what people said. And it's good to see that 65% actually said that money and risk management was the most important. So at least they put a lot of weight on that, because it is very important. But I just want to draw your attention to personal mindset was only roughly 20%. And I think that this is largely reflective of how people actually think about investing. So really what it comes down to is, what should you actually expect? Because a lot of times what we find when we have a lot of anxiety and angst about what's happening in the market, it's just because there's this massive disconnect in between our expectations and what the market's trying to tell us. If you can become an expert at identifying what is, you're leagues ahead of most people. So always keep your expectations properly rooted in what is, in what trend following can deliver over time. And then you won't think that you're a complete idiot in a bear market, and you won't think that you're a complete genius in a bull market, right? So when you look at this diagram, we're all familiar with this schematic, but look at that first quote: cut your losses short and let your profits run. That's what this is. Positive skew. Cut your losses short, let your profits run. This is trend following, and this is why it works over time. But it's also why it's extremely difficult to do if you don't have proper expectations, if you're not expecting the possibility that you'll lose 60% of the time. As long as your gain is 2 to 3 times larger than your average loss, you actually will win. In a bull market, it's why everybody gets attracted to trend following, because it seems so easy to do, but it's also why so many people flush in and out of this strategy. There's this perception that Warren Buffett is the best stock picker of all time. And I think there's danger in just accepting that, meaning that, like, well, if Warren Buffett is where he's at because he's a great stock picker, that means that I need to become a great stock picker. I've constantly said that there's this expectancy formula that everybody has to go through, even Warren Buffett. And what that expectancy formula is your profit is equal to how often you're right times how much you make when you're right, minus how often you're wrong times how much you lose when you're wrong. And you just do that formula. And if it's a negative number, stop what you're doing, because what you're doing is not working. If it's a positive number, keep doing it because it works, right? But so what I've always said is that even Warren Buffett has to live and die by that reality of the expectancy formula. But it really made me smile when I was reading Warren Buffett's annual report from 2022. And I caught this statement: at this point, a report card from me is appropriate. In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. if you're a devout Warren Buffett follower, you may have had a heart attack hearing your this god of stock picking say something like this. But this is the truth. This is coming from the man who actually developed the track record that everybody is so enamored with. This is the truth. He goes on to say, our satisfactory results have been the product of about a dozen truly good decisions. Sound familiar? That sounds like trend following to me. That would be about one every 5 years, and sometimes a forgotten advantage that favors long-term investors such as Berkshire. So it's about having this strategy that works over long periods of time. But the truth is, the reason he has done so well is because it's about a dozen really smart things that he did well over the past 58 years. Not everything he touches turns into gold. This is Warren Buffett himself. So the lesson for investors is the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. If that doesn't sound like trend following, I don't know what does. This is the man himself telling us that it's not about being a godlike stock picker. It's about when you recognize you have something good, let it go, right? Cut your losses short, let your profits run. That was stated back in the 19th century, 1800s. So here it is. This is the man himself telling us that it's a lot more about recognizing a good thing and letting it run than it is being a golden boy stock picker.